Are you aware that more than 60% of millionaires are debtors? Here, this is interesting. They are getting richer by leveraging on debt. Most of us look at debt and see a weight to bear. For the wealthy, that's not the case. So, let's find out how debt can be used as a tool by the rich to earn more. Chapter 1. Debt financing in real estate investment. It's quite common for the wealthy to have debts, and this is because they use their debts to enhance their capital in real estate ventures. Instead of purchasing a house or other property, they use a loan or mortgage, which allows them to own a large, appreciating asset with little upfront cash. This allows them to let the asset appreciate in value over time, while gradually retiring the debt with rental income or profits from the sale of the house. Consider the example of Robert Kiyosaki, for instance, the author of Rich Dad, Poor Dad, who has appreciated the ability of good debt for quite a long time in financing income-generating investment like property real estate. He adds that taking a loan against low interest rates and using it to acquire assets that appreciate creates the ability to use other people's money in building wealth. Kiyosaki terms this method OPM, other people's money, which means you are not investing all of your capital at once. You avoid putting all your eggs in one basket. On the other hand, you enjoy the profits when the property appreciates. This is more than just a theory, since it is supported by tangible evidence. As per the 2019 statistics provided by the National Association of Realtors, real estate alone represented nearly 90% of the total wealth of all the millionaires in the world. The most interesting aspect of real estate is the fact that it offers the possibility of short-term cash flow via rent, along with long-term wealth via appreciation. What lesson can be taken away from this? Certainly not all debt is bad. For wealthy people, acquiring income, producing or appreciating assets along with debt is a game changer. Rather, it is about using loans as a means to leverage expansion rather than create a burden. If followed in the right manner, the earnings generated from the property can outweigh the cost of obtaining the loan, which makes this method quite useful and remarkably effective. Chapter 2. Use of low-interest debt to fund stock investments. The wealthy utilize debt not only for real estate purposes, but also for investments in non-real estate assets, such as stocks, particularly when the interest rates are pretty low. They take out loans at a lower rate of interest than their anticipated return on investment in quality stocks. It's like borrowing at a 4% interest rate in order to achieve an 8% annualized return on investment. The difference between the cost of borrowing and the returns is how they make a profit. Consider, for instance, Warren Buffett. This major investor believes firmly in what's called margin debt, borrowing securities from a brokerage and using them to purchase more stocks. Indeed, this company, Berkshire Hathaway, has multiple billions in debt, but not because they are financially distressed. Rather, this is because they are able to generate a higher return on this borrowed money through investing out of the proceeds generated. The way Buffett has managed the company indicates that debt can enhance returns if used cautiously. By obtaining funds at lower rates and subsequently employing these into equities over the long run, Buffett has been able to maintain and even grow the company, Berkshire Hathaway. Nonetheless, this strategy comes with its own set of risks. On the other hand, depending on how low the market goes, there is loss exposure, although high net worth individuals tend to limit this risk by making more diversified investments in secure stocks or industries. Morgan Stanley indicates in its research that among other affluent investors, over 20% invest in stock using borrowed money, which many view as a method of improving their portfolio returns in the long term. For absolute beginners, this may sound daunting, but the bottom line is that the rich use debt, but in a tactical way. They do not incur it for the purpose of quick gains. They take on debt for the purposes of capacity expansion in order to be able to make larger, long-term returns that are more than the debt repayment costs. Chapter 3. How to leverage low-interest loans to buy stocks. The economy leads many to participate in the stock market. Unfortunately, many investors lose money in the process. Loans have often been regarded as con, but only if seen with the perspective of abuse, which leads to the final epiphany of debt is bad. Here's a twist. Most people don't consider borrowing money can actually make you money if you invest it smartly. And one way rich people do this is by using low-interest loans to buy stocks. Leverage is what it's called, and quite frankly, if you can get it, you should. Greats like Warren Buffett go on to use margin debt, which paints the borrowed perspective even clearer. Eric Gordon writes, "Most investors aren't aware of the existence of unlimited debt, which results in a very limited scope for returns. And any day will understand that in order to win the long game, one must not solely rely on their equity stake." Buffett's company, Berkshire Hathaway, has often resorted to leverage as well, which is essentially using more debt to fuel long-term investments by betting on markets having consistent returns that will further allow the growth of the investment. According to Morgan Stanley, around 20% of wealthy people utilize loans as an investing technique, which isn't a widespread application, but fairly popular nonetheless. And with good reason. The loans are timely and meant to take the risk away, not put in risk the entire portfolio. Factors such as patience and timing rather than luck are essential in this instance. Through the years, the wealthy investors understood that the market booms in the long term. Therefore, they take out loans at low interest rates and invest in safe stocks. Then, they simply wait for their earnings to surpass their borrowing expenses. It's not a rapid victory, but rather a steady one, which has the potential to accumulate significantly over time. Imagine fueling a car loaned out against the value of its future returns. Yes, it does sound risky, but as the wealthy have low-interest loans and a wise selection of stocks, they change the meaning of risk from negative to positive. For them, debt is not a suck, even though it sounds like it. Rather, it is a means to grow even more wealth. Chapter 4. Using leverage for corporate expansion. Consider a scenario where you know someone who can recognize the best potential sites for a business, say a small coffee shop tucked away in a back alley, desperately seeking someone to build it up. Well, rich people will steal that strategy too, but only on a larger scale by acquiring companies with debt. This practice is referred to as a leveraged buyout, LBO. And it simply means taking a loan to purchase a company with the belief that it will be profitable enough to repay the loan and generate good returns. Consider, if you will, the case of Kohlberg Kravis Roberts, KKR, a well-known player in the private equity space. They rocked the headlines in the 1980s after taking substantial debt to buy a well-known company, RJR Nabisco. And they did not just leave it at that. They restructured, turned it into a more efficient business, and sold it at a higher price. However, KKR is not the only player. Other private equity companies are engaged in buying, improving, and selling businesses for a large margin. However, it is not only the dominant ones that engage in the game. Other investors include small businesses and individuals. Given the amount of the loan made to buy a viable business with good cash flow, they would be able to furnish the loan and enjoy the benefits of the business earnings. Apparently, some researchers from Harvard Business School examined a series of leveraged buyouts and discovered the average return on this type of investment to be approximately 20 to 30%. So, what do the rich get out of these investments that involve so much uncertainty and risk? It is with the expectation that the cash flows of the business will be enough to service the debt. Properly managed, capabilities of leverage far outweigh the burden of debt, allowing one to control more assets and generate larger cash flows without full personal risk. This astute application of leverage can shift a high-risk proposition into a more or less risk-free bet for increasing one's wealth, proving that debt, when utilized the right way, is an asset that can be beneficial in the pursuit of growing one's finances. Chapter 5. Hiring debt to acquire highest return on investments with low taxation. Next up, let's move to the more practical aspects. How it's possible to borrow debt and use it to make investments without huge tax burdens. Sounds too sophisticated, but it is merely about the right measures being taken to reduce cost over a period of time. For example, one common practice is to borrow in order to invest in the tax-advantaged municipal bonds, or in certain forms of real estate development. Wealthy people, for example, have no shyness in rushing to put money into the real estate projects in opportunity zones. These zones are areas in the United States that have been targeted for investment, which come with great tax incentives. By putting their own cash to work in these investments, they not only assist in rebuilding these communities that are in need, but they also reduce their tax liabilities. Evidently, this is not just any tax investment, as the U.S. Government Account Office acknowledges that billions in private investment have, in fact, gone into opportunity zones. As such, it is a win-win situation for both the investment objectives and the purpose of the opportunity zones. A great form of diversification for investment is by purchasing municipal bonds, which are securities offered by states or municipalities which represent debt owed to bondholders. These types of bonds do interest earning, which are free from normal taxation as well as state taxes. So, take for instance, you make a low-interest loan to buy these bonds while earning an interest free from taxation. It thus helps the rich investors to earn money while lowering the amount they have to pay out for tax. This approach allows the wealthy to not only increase their wealth by increasing these tax-free investments by using debt, but also develop a strategy that allows them to retain more of their wealth. It's all about debt to acquire money that you can then use to invest and generate greater wealth in the future. But for the rich, there is nothing to worry about because the debt is an important factor for constructing a stronger financial future. Nothing in this video is financial advice. This channel is designed to make financial education accessible and fun for everyone, kids, teenagers, and young adults. Whether you're starting your money journey or just looking to sharpen your financial skills, these videos are perfect for you. Share this video with your friends, family, or even your kids, and help them build strong money habits for a brighter future. Let's grow smarter together. Don't forget to subscribe to the channel for more tips.